All right, let's dive right in. Today, we're pulling back the curtain on the securities market. You can think of it as this giant, invisible engine that connects the world's biggest ideas with the money they need to actually happen. So let's get into it. Have you ever thought about that? If you've got some savings tucked away, and over here there's a company that needs cash to expand, how do you two ever find each other? Well, the answer is this amazing system that we're about to break down. Because at its heart, the securities market isn't really about all those complicated charts and flashing numbers you see on TV. Nope. It's about making one single, incredibly powerful connection. And this is it. This is the core function right here. The market is basically a massive pipeline that channels money from savers to the companies and governments that need it to build and grow. And by bringing together countless buyers and sellers, it creates something called liquidity, which is just a fancy way of saying it's easy to buy or sell an investment pretty much whenever you want. So what is this thing that's being bought and sold? What's the security? Well, it's actually pretty simple. It's just a tradable financial contract. Think of it in one of two ways. It's either a little piece of ownership in a company, or it's a formal IOU that says someone owes you money. That's the instrument that makes this whole thing work. Okay, so if the market is kind of like a restaurant, then what's on the menu? Let's take a look at the main dishes, the different kinds of securities you can actually invest in. You can really boil it all down to two main categories. First, you can buy equity. This means you're buying a small slice of a company, becoming a part owner. Or, second, you can buy debt. This is more like giving the company a loan that they promise to pay back with interest. So, ownership or a loan. That's really the fundamental choice you're making. An equity share is the perfect example of ownership. When you buy a share of a company, you are literally buying a tiny piece of that business. Now, if the company does great, the value of your piece can go up. But if it struggles, well, you share in that risk too. High risk, high potential reward. Now, on the other side of the menu, you've got bonds or debentures. This is the loan option we talked about. You lend your money, and in return, you get a promise of regular, fixed interest payments and your original money back when the term is over. So for investors who are looking for a little more predictability and maybe a steady income stream, this is often the way to go. But what if you can't decide between all these options? Well, that's where a mutual fund comes in. Think of it like a combo meal. It pulls money from lots and lots of people, and then a professional manager invests it all for you in a wide variety of stocks, bonds, and other stuff. It's a super easy way to spread your risk around without having to pick every single investment yourself. Now, it's important to know that these securities aren't all just traded in one big, messy pile. The market is actually split into two very distinct arenas, and it all depends on whether an investment is brand new or, let's say, secondhand. First up, you have the primary market. The best way to think about this is like a car dealership selling a brand new car for the very first time. This is where a company creates brand new shares and sells them directly to investors. Why? To raise fresh cash for the business. And the most famous event in the primary market is, of course, the IPO, the initial public offering. Here's how it works. A private company decides it needs a lot more money to grow, so it works with financial experts to sell its shares to the general public for the very first time. And once that IPO is done, its shares get listed on an exchange, and boom, it's officially a publicly traded company. So what happens to all those shares after the IPO? Well, that's where the secondary market takes over. This is the giant marketplace for used securities. It's where investors like you and me buy and sell from each other, not from the company itself. This constant back and forth trading is what provides all that liquidity we talked about. So on a formal stock exchange, everything is centralized. There's a special organization that acts as a middleman to guarantee every single trade. It makes sure sellers get their money and buyers get their shares. It's pretty safe. But then there's over-the-counter or OTC trading. That's different. It's a direct deal negotiated between two people. It's more flexible for sure, but it also carries more risk if the other person doesn't hold up their end of the bargain. Okay, so this whole system doesn't just run by itself, right? It's powered by a whole cast of essential characters, and each one plays a really specific and vital role. So, let's meet the players. First off, you've got the issuers. These are the engines of the market. They're the ones who need the capital in the first place. We're talking about companies that want to build new factories, governments that need to fund new roads and bridges, and financial institutions that need money for their own operations. Next up, the investors. They provide the fuel for those engines.
This includes what we call retail participants. That's just regular folks like you and me. And also the massive institutional investors. You know, the big players like pension funds or insurance companies that are investing huge sums of money.
And finally, you have the intermediaries. These are the connectors that make the whole thing work seamlessly. You've got the stock exchanges, which are the actual platforms where trading happens. You have stockbrokers, who are the agents that actually place our buy and sell orders. And then you have depositories, which are kind of like digital vaults that hold all our securities safely in electronic form.
So, we've covered the what, the where, and the who. But let's just zoom out for a second and ask the big question. Why does any of this actually matter?
Well, this entire complex structure serves a massive purpose. It very efficiently moves money from where it's just sitting around in savings accounts to where it can be used productively, to create new jobs, to develop new technologies, and to build infrastructure. It is a fundamental driver of a country's economic growth.
And one of the biggest changes that made today's fast-paced market even possible is something called dematerialization. It sounds complicated, but it's just the simple but profound shift from holding physical paper stock certificates to holding them electronically. This move from paper to pixels made trading so much faster, safer, and opened it up to millions more people. It was a total game changer. And that really brings us to the end of our little tour. We've seen how the market connects savers and builders, the different things on the menu, and all the players that make it happen. So the only question left is, now that you kind of see the blueprint of this powerful economic engine, how do you see yourself fitting into it?